Proud supporters of Africa this week. Engine, with us, you are number one.
Hello and welcome to this edition of Africa This Week, your wrap of what happened across the continent. I'm Mashudu Masuta. The remarkable growth and investment potential in both China and Africa makes for a dynamic partnership in global economics. Whether Africa and China can have a win-win partnership is another issue altogether. Producer Buntu Williams went to find out at the China-Africa Business Forum held in Johannesburg.
The general belief is that the Chinese dragon has invaded the African jungle. Armed to the teeth, it boasts flying abilities, fire-breathing tricks, and immeasurable strength. But is this perception the consensus on Beijing?
There is a perception in Africa seeing Chinese investing or operating in this continent because mainly Chinese investments in Africa are related to resources such as oil, mining, copper, coal. And today it happens that we see more Chinese investments in services, which means that there is a diversification in Chinese investments and operation in Africa.
Economies and nations compete. Self-interest drive their actions, drive the plans, drive the implementation. And that will not change. China is competing very aggressively with the world, but it's complicated. Being part of a formation such as BRICS allow for the developing world to do more, to integrate more and find opportunity and collaboration more easily. But that does not detract from the fact that for the rest of time, all these countries compete. The question is, how can policymakers, CEOs, boards of companies use these constructs like BRICS, the next 11 other groupings to make their businesses or their organizations compete more effectively. China is a $6 trillion economy. In BRICS alone, the next biggest economy is a $2 trillion, and then after the $1.5 trillion economy, with South Africa coming in at less than 400 billion. So they're very different. They will be able to compete in different areas and in different ways. They're not the same, and that we have to accept. But we must continue to look for the opportunity and leverage BRICS to our advantage as a small economy in the case of South Africa, in terms of how that then relates to our positioning in Africa and our positioning on the global stage.
Seeing that Africa is indeed in need of Chinese investment, how can the continent play to a win-win position in its relations with China?
We're making progress. I think first of all, our leaders, our business leaders, government leaders are looking at the world differently. We're seeing what are the hotspots, what are the areas of concentration for capital, where capital will flow from, where markets are, where markets will grow, where we need to engage, whether it be to export, whether it be to attract capital, whether it be to build supply chains, whether it be in high-end goods and value-added industries, whether it be in the resources. So I think that's the first step. And I think we are making progress. But have we got it exactly right? Not yet.
Different countries have different priorities. So a very poor country, for example, South Sudan, which now recently became independent with almost no infrastructure, no industry, they will have very, very different priorities and very, very different modus operandi from a country like South Africa that has almost a first world infrastructure and legal framework. So one could have principles and one should promote certain minimum levels of conduct. But I think in terms of creating investment policies, there's still a very, very long way to go before African countries are united on that issue.
And this is an evolution. This is where we must make sure that when investors, whether they be Chinese or Asian or any international investor, when they do due diligence in buying equity, in buying into a project, in making co-investments in South Africa relative to elsewhere in Africa, that we seem competitive, that we seem open for business, that we have a playing field that makes sense, that we have the regulations in place, that we send confidence signals rather than signals of confusion.
There is consensus, however, that Chinese investment can actually enhance local business and corporations while enhancing a country's social agenda.
What Africans think about Chinese investment in those sectors like mining, oil, copper, it's something. I mean, it's like they're taking resources from Africa back to China. But if you look at the telecom industry, there is no such thing that happens. I mean, because the only thing that happens, it's like they're investing in services in Africa to help and develop, services businesses in this continent. In terms of telecom, Huawei and ZTE are here to help African local network providers to build equipment and to widen their network coverage. And maybe later on they will even focus on broadband internet.
So the George Orwell dictum still holds true. In the jungle, some animals are just more equal than others.
Some small players can be competitive, that we've seen, and some very large players can sometimes act slowly. But if all the big players are acting at the top of the game, it would make it very hard for the small players if they act at the bottom of the game all the time. That's not how the world works. It's about people, it's about awareness, it's about CEOs thinking differently, it's about education, it's about information management. And I think that's where a smaller player can focus on the right niche areas, can be more proactive, can be quicker to react, and can be more strategic. And that in a way then levels the playing field somewhat in favor of those that are not merely large, but those that act at the top of their game.
The increasing penetration of China in the African market is spearheaded by the major Chinese state-owned companies who have access to long-term financial support from the Chinese state. This is an opportune moment for African countries to address the backlog of infrastructure investment that has long kept African development at a disadvantage. For our regular China-Africa update, we spoke to Professor Michael Chege, Economic Advisor to Kenya's Ministry of Planning and National Development, National Economic and Social Council.
The money is coming mostly from the Kenya government. In the case of the big road to Thika, it is the African Development Bank with the Kenya government. In case of the airport, it's the World Bank with the Kenya government. The Chinese construction companies here are winning hands down when it comes to tendering. This is what you're observing there. And in addition to that, i.e. presence of large Chinese construction companies is of course, their entry into investment in the private sector, but most important of all, trade.
Okay, so basically, I think what you're saying to me is, we're partnering with the Chinese on infrastructure development, but we haven't ransomed the country. And that's really the argument that many people often raise when they're dealing with China's investment strategy in Africa, is that whole commodities for infrastructure, commodities for loans model. What's the model that you've embarked on in your dealings with China?
Well, I would say the Kenya government rather than myself. The way it's turning out is that China is turning out to be a strategic partner in the construction industry of infrastructure, mostly by competitiveness as contractors, but also turning Kenya into their gateway for trade in the East African common market, in the East African community. On top of that, there's increasing interest by the Chinese in wholesale and retail trade, as well as light manufacturing. And of late, they've come into automobile assembly in Kenya, and that is becoming an important area for their operations here. In other words, the Chinese are betting in the long run that they'll matter here, and we're beginning to see evidence of that.
I'm glad you mentioned this issue of manufacturing, because it's been a debate that's been raging even at the World Bank annual meetings recently, is as the costs of labor rise in Asia, Chinese manufacturers are going to look for areas where they can produce cheaply and with high volume. And with labor and wages being what they are in Africa, this is probably where they should come. You're making it attractive for them to do so. Do you see yourselves as probably the industrial center for Chinese manufacturing in East Africa? Is that how you're positioning yourselves?
I think our advice to the government is that we should be moving in that direction. What we should know for sure, though, is that although it's often presumed that Africa is a low labor cost economy, is not always the case. It can be quite expensive because often the training is not right, and the discipline of the labor force, and the manner in which our labor is integrated into the commercial sector has not been encouraging to entrepreneurs. What we need to do is to make sure that our labor costs are much lower than our competitors, because those Chinese firms who go to Vietnam, Bangladesh, and India, possibly, Mauritius. We want them here, and we have to train our workers, we have to train in our schools and make sure that they're getting the best value for money. That way, those Chinese firms and industries will come here. And it will be our turn now to export to the global market using that platform.
Africa, home to 7 of the 10 fastest growing economies in the world, is set to double its gross domestic product in the next 10 years. However, for the continent to achieve this, the public and private sectors will have to work together. Our team attended the 10th anniversary of the new Partnership for Africa's Development in Johannesburg this week and filed this report.
The theme for the 3rd annual NEPAD African Ambassadors Dinner was the role of public and private partnerships in achieving sustainable economic development. Stanley Subramani, chairman of the NEPAD Business Foundation, says Africa is a far more investor-friendly destination now and offers better returns and profit margins.
We know that Africa is hungry for infrastructure, it's hungry for power, it's hungry for telecommunications. So every conceivable product that is consumed in this consumer market, every single large multinational that has got a product to offer will find that Africa is open for business. It will offer margins that are significantly higher than the rest of the world. It will offer an environment that is better in terms of growth potential. But more importantly, it will offer those businesses a greater lifespan in terms of their long-term strategy from a business point of view.
When NEPAD was set up in 2000, it set an African GDP target of 7%, a figure which has proven to be just out of reach, with Africa expecting a 5.1% growth for 2011. But the role of business in development on the continent is pivotal.
We talk about smart partnerships relative to working with governments, together with governments, in terms of making a difference. The opportunities are massive. You just need to go to any country across the continent and you'll see for yourself that there's massive opportunities. So PPPs is one way to do it. Strategic partnerships with other governments is other ways to do it. But certainly we see infrastructure as a way that will continue to power the African continent in terms of the growth part to 2020.
The continent's GDP is set to double to $2.2 trillion by 2020 from the current $1.6 trillion. However, South Africa, the continent's biggest economy, says for these numbers to be realized, more intra-African trade will be needed.
If you look at the map of Africa and you look at the rail infrastructure, for instance, you'll see all the rail moves from certain countries with particular resources to the sea, to the ports. And the purpose there was basically to export raw materials outside to countries outside the African continent. And that necessarily established the trend of Africa trading with the outside world and not with itself.
The NEPAD leadership is aware that business and investments thrive on stability, and in the face of changing leadership, a delicate balance is needed.
Private sector looks very carefully at risks associated with investments, and the changing leadership on the African continent is dealing quite decisively with some of the risks that are identified by the private sector. For instance, issues of stability, political stability, issues of good governance, issues of peace. Those are the issues that are currently the driving approaches of the current leadership on the African continent. And therefore we see these as addressing the risks that are pertinent in any private sector investment. And therefore we see greater opportunities and chances in future that we'll see the growth of public-private partnerships in the development of the African continent.
Dr. Ibrahim Mayaki, CEO of the NEPAD agency, also told us about the priority areas for the continent.
Agriculture will be a main priority, and what we intend is to transform Africa in a global food producer, because as you know, the food shortages in 2030 will be quite critical.
After the break, more stories making headlines this week.